A perfect will can still send your money through the slowest, most expensive door in the building. That sounds wrong because the will is the thing everybody signs and then feels finished. Sign it, file it, breathe out. But a will is not a set of instructions that money automatically obeys. It's a document that tells a court what you wanted, and a court is exactly the part of this you'd want to skip. Estate attorneys watch families discover this months after a funeral, when the paperwork starts moving and nobody can figure out why nothing is moving fast. And the reason has almost nothing to do with how well the will was written. Here's the number that makes it real. Take a family with roughly $2 million in assets. Probate costs, meaning court fees, filings, attorney and executor compensation, commonly land somewhere in the low single-digit percentages of the estate that passes through it. Call it 2 to 4% as a rough working example. On the portion that goes through probate, that's tens of thousands of dollars, 40, 50,000 in some states, just to walk paperwork through a process. Nobody stole it. No advisor charged it. It's friction. And the strange part is that the same $2 million, held slightly differently, could have skipped most of that door entirely. So what's actually being lost? 3 things, and only one of them is money. There's the cash bleed, the court fees, and the professional time. There's the delay, because probate can run months and sometimes past a year, and heirs who needed liquidity for a mortgage or a tax bill just wait. And there's privacy because a probated will becomes a public court record, which means the neighbors and anyone curious can read what your family got. Wealthy families rarely lose everything in this process. They lose margin, months, and quiet. That's the leak. And the mechanism behind it is boring enough that almost nobody checks it. So let's take apart how the money actually travels, because there are exactly 3 mechanisms doing the work here. And the will is only one of them. First, the ownership layer. What the will controls versus what it never touches, and why a beneficiary form quietly outranks it. Second, the tax and structure layer. What the trust actually does and what the current federal estate exemption really means for a family sitting near the line. Third, the human layer, which is the one attorneys say gets skipped every single time and causes the most damage. 3 mechanisms, and the third one is where the real money disappears. Start with ownership, because this is the piece people get backwards. A will only governs assets that are titled in your name alone with no other instruction attached. That's it. Your 401k, your IRA, your life insurance, most brokerage accounts with a transfer on death designation, those all pass by contract. The custodian looks at the beneficiary form on file and pays that person. It does not read the will. It does not care what the will says. If the form says one name and the will says another name, the form wins, and the money is gone before the executor even opens the folder, which produces the single most common disaster attorneys describe. A retirement account opened at 30, beneficiary form filled out with a spouse's name, then a divorce, then a remarriage, then 25 years of never touching that form again. The will names the current spouse. The form names the first one. On an account that grew to $400,000, that entire $400,000 goes to the name on the form. Attorneys have watched families spend more fighting it than the account was worth, and mostly lose, because the contract was clear. And the fix costs nothing. Which raises an awkward question about the second layer. Now, notice what just happened. The ownership layer didn't fail because someone made a bad decision. It failed because nobody reviewed a form. That's the pattern in almost every one of these gaps, and it's why the second layer, the structural one, gets misunderstood so badly. People hear the word trust and assume it's a tax dodge for the very rich. That is not what a revocable living trust primarily does. It does something much more mundane and much more useful. And understanding what it actually does is the difference between paying for a document you needed and paying for a document that just sits there. A revocable living trust is a container. You move the title of assets into it while you're alive. You stay in control as trustee, and when you pass, the successor trustee distributes according to the trust terms. No court, no public filing. That's the point. It's a probate avoidance and privacy tool first. On that $2 million estate, sidestepping the probate door on most of the assets is what claws back that 40 or 50,000 in friction, plus the months. But there's a catch that attorneys say happens constantly, and it turns the whole thing into an expensive paperweight. The catch is funding. A trust only controls what's actually been retitled into it. Families pay several $1,000s to have the trust drafted, sign it, feel finished, and never move the house deed, never retitle the brokerage account, never assign the business interest. So the trust exists and owns nothing. The assets stay in the individual's name, which means they go straight back through probate anyway. An unfunded trust is one of the most common findings attorneys report, and it's a pure loss because the family paid the drafting fee and still ate the court cost. If this is the kind of mechanism you want explained properly, subscribing takes about a second. There's also the tax question, and it's worth being precise here because the numbers get exaggerated. The federal estate tax exemption is currently in the range of roughly $14 million per person, meaning a married couple can shield somewhere near $28 million before federal estate tax enters the picture at all. That's why most families do not have a federal estate tax problem. What they can have is a state-level one, because a number of states impose their own estate or inheritance tax at far lower thresholds, sometimes starting around 1 or 2 million. And that gap is where planning actually earns its fee. There's a related detail that quietly saves families real money, and it involves the step-up in basis. When appreciated assets pass at death, the cost basis generally resets to the value at that time. A stock position bought for $100,000, now worth $600,000, would carry a $500,000 embedded gain if sold during life. Inherited with a stepped-up basis, that gain largely disappears for the heir. Which is why gifting an appreciated asset early can sometimes cost a family more in taxes than simply letting it transfer at death. Same asset, different door, wildly different outcome. Which brings us to the third mechanism, and this is the one estate attorneys say they wish families understood before the documents ever get drafted. Because everything so far has been about plumbing. Titles, forms, containers, thresholds. All of it can be perfect. The beneficiary forms updated, the trust funded, the state tax modeled, the basis handled. And the family wealth can still evaporate in a generation. Not because of the court, not because of the IRS, because of something that has no line item on any spreadsheet and never appears in a will. And it's remarkably consistent. It's that the heirs were never told anything. Attorneys describe reading a trust to adult children who had no idea the trust existed. No idea what was in it. No idea who the accountant was, where the business paperwork lived, or what the parents actually intended for the family home. So the first real conversation about a lifetime of money happens in a conference room, 6 weeks after a funeral, between siblings who are grieving and now negotiating. That's not a document problem. That's an information problem, and it produces the most expensive outcome of all. Litigation. Sibling against sibling, contesting a trust or a will, with legal fees running $50, $100, sometimes several $100,000 paid out of the very estate they're fighting over. It's the only cost on this list that has no ceiling because it grows with the anger. And the second version of the same problem is quieter. An heir receives a lump sum, 7 figures, having never managed more than a paycheck, and there's no framework for what to do with it. The money isn't stolen, it's just spent, because nobody was taught to hold it. So here's the insight underneath all 5 of these gaps, and it took the whole video to earn it. Every single one is a communication failure wearing a legal costume. The stale beneficiary form is nobody reviewing it out loud. The unfunded trust is nobody confirming the transfer happened. The state tax surprise is nobody asking where the family actually lives. The contested estate is nobody explaining the reasoning while they still could. Attorneys aren't paid to draft magic. They're paid to force conversations that families avoid, and the families who avoid them longest pay the most for that comfort. None of this is a recommendation for your situation, and it can't be. Your state's rules, your asset mix, your family's specifics, those belong in a room with a licensed estate attorney and a tax professional who can actually see the whole picture. What you can walk away with is the mechanism. A will directs a court. Beneficiary forms and titles direct the money. And the story you tell your family directs everything the paperwork can't. If watching where money quietly leaks is interesting to you, that's most of what happens on this channel. So stick around and I'll keep decoding it.